And there you have it, your closing bell on this Fed day. Let's take a look at where the major indices ended. They did accelerate into the close. We see where the Dow settled off more than 500 points. That's past a 3-month low. The S&P 500 there losing about 1.7%. Tech-heavy Nasdaq losing about 1.8%. Both of those also nearing 3-month lows as well. Well, let's take a closer look at the broader markets and bring in our panel. We have Christian Hoffmann, Thornburg Investment Management Portfolio Manager and Managing Director, and Eva Ados, ERShares COO. So, Eva, I want to first start with you. This reaction that we saw, this real roller coaster in the afternoon, how do you think markets are digesting what they heard from Powell today?
We expected that reaction. We think the 75 basis points was a foregone conclusion, but we did expect Jay Powell to be as hawkish as he was. The last CPI report was not that good. And we do expect the markets to continue their roller coaster, as you very well described, that we're seeing today in the next couple of weeks until the next catalyst that we see in October. So I think the CPI report in October and the early November Fed meeting, that will be the next catalyst that has the potential to push the markets higher, as we might see the Fed easing up on the 75 basis points rate hikes.
So, Christian, Dow closing off today 522 points. Further downside risk ahead?
The volatility will continue until morale improves. The reason that it's going to stay volatile for a long time is because the market is broadly hyper-focused on inflation, and so is the Federal Reserve, and rightly so. And it's a question over a prolonged time, and are we looking at inflation at 7% or 5% or 3%, and how long does that persist? And we're back to fundamentals here. We're back to valuations, and that impacts all valuations from bond markets to equity markets. And the market is hyper-focused on every single economic data point, trying to extrapolate that longer-term trend. And so the volatility is going to continue for here, absolutely.
Ava, was there anything in particular that surprised you that the Fed chair said today? And what's your reaction to him describing it as very challenging to accommodate, to pull off the soft landing?
To me, the biggest surprise was his point during the Q&A regarding housing, because housing, as we saw, the CPI for housing in the last report increased by 0.7%. However, we have seen over the last months headlines about new housing starts dropping, home prices falling. So it was inconsistent. And we do believe there is a big lag here between what the CPI suggests for housing and what's actually happening, because the CPI is only tracking owners' equivalent rent. And that does not take into consideration the actual prices of homes being bought and sold, but rather what a homeowner would rent his house for if he had to. And that includes also other costs such as maintenance and taxes. So it's not really a good indicator. And we think there is a lag, but Jay Powell made it clear that there might be a big lag between, and it might take a long time until we see housing prices come down.
Ava, just for clarity, are you saying there was something from Powell that was inconsistent when it comes to housing? And how far are we from the correction that he said the market does need?
He made it clear that it will take time to see housing prices drop. We did not think that it's going to take so long. So that was the biggest surprise to us. And we're again concerned the CPI, even in the next CPI reading, might not show the true reality for housing. So we're just want to make sure that people are very clear on what data they're looking for, because the CPI for housing does not always show the reality, and it lags.
So then, Christian, given that data and what we heard from Powell's comments today, how is that informing your investment strategy going forward?
Well, for one, I think it's an incredibly rich time to be investing in fixed income, especially as you contrast it to the opportunities last year where core rates were ostensibly zero and spreads weren't much higher than that. You know, at this point, we're finding opportunities where you can invest in 2-year AAA rated paper and get nearly 6%. You can buy high-quality performing bonds at 80 and 90 cents on the dollar, have a great convexity profile and long-term total return. So, like I said, it's going to continue to be choppy, but it's actually a very rich opportunity set for investing in fixed income at this point in time.
Well, Christian, what is your assessment just of the bond market right now, more broadly speaking, when you take a look at treasuries, right? The 2-year yield jumping to 4.12, hitting a high, the highest level we've seen since 2007. The 10-year yield also jumping to its highest level that we've seen in 11 years. That trend, you don't think that that will stay intact?
Again, I don't think we've necessarily put in the tops in terms of rates. But if you're looking at positive real rates, that's actually quite attractive. And relative to your views, there's actually a number of ways you can express a high total return potential depending on your views of inflation and Fed policy. The Fed is in this weird place where they're playing this tug of war with the market, that the market is trying to front run the Fed, trying to see when they're gonna blink. And they absolutely will, but the Fed is trying to look as tough as possible. I wouldn't be surprised to see Chairman Powell come out in the next meeting, wearing a leather jacket and having a neck tattoo, because they are hyper-focused on trying not to flinch against the market. And, that tug of war is going to continue. You saw it in the press comments when the market bounced. People were looking for anything, any silver lining, and there was some slight hint that they might ease up, and that's when you saw the bounce and the reversal. That was wrong. That was the wrong take, and you saw that unwind through the day.
Brother, thank you for that image. I will not unsee that all day. Jerome Powell, neck tattoo and leather jacket. I'm just going to dream about that. But Ava, I do want to get your thoughts on the 2-year at 07 levels and Christian's strategy of fixed income in this environment.
We're not big in fixed income, and we would certainly not encourage people to go long bonds because of their exposure to interest rates. So as interest rates go up, bonds will come down. However, the short term is a good investment. So the 3-month, the 6-month, it's really tough now with anything when it comes to investments. So throughout the world, geographically, asset-wise. So throughout the world, there are very few markets now that will actually perform well. But one hidden gem is India, which of course is a market that is really hard to get in and out due to the regulations, but it's one of the few markets that's flat year to date, as they've benefited from the oil trade and their partnership with Russia, because they're buying the oil, refining and then reselling it to Russia, to Europe. And so that's one of the bright spots. And then we would encourage investors to stay conservative in the markets, equities, and then add to their positions as we approach late October and early November.
Ava Ados, Christian Hoffmann, thanks so much for joining us. Always great to have you here at Yahoo Finance.